Well, I think the sentiment right now, it really shows from uncertainty. When you get uncertainty in the economy, and I think businesses have uncertainty now, and then that makes people have uncertainty. And then if you look at everything going on job-wise and the government on down, you've created this highly uncertain period. And when you get that, that's probably one of the worst periods you can have for the stock market, because the stock market's never liked a lot of uncertainty, and that's what we have right now. They don't know what to do, because you can't plan on something when you don't want. If you tell me, okay, this is what's going to happen in your company, you're going to have to do this, pay X, that's one thing. But if you're saying, well, you're going to pay X today, but we changed it and you'll pay half X tomorrow. Oh, by the way, 4 days from now, maybe you're paying 2X. Companies have a very hard time with that, because, that's not the kind of thing they can buy inventory for, buy cost of goods sold, that sort of thing. And it's not just the public companies, it's the private companies too. They have this problem, not all companies, but if they're buying goods that are coming in, they're all thinking about that, and that's where we are right now. One of the things that I think people have forgotten is risk management. The reason they have is because you've had 15 years of nothing to worry about in the marketplace because of the Fed and the fiscal policy with all this money. But now things are changing, and people should probably start to think about, how do you manage risk? And for us to manage risk, we own treasuries. Now, you can manage it different ways, but for us, if we don't have something to buy, which in this case, we bought 6 or 7 things since January 1. But the thing is, if we don't have anything to buy, then we just hold it in the treasury, because things are not cheap enough for us to go into it. That really is our style of, if you want to call it market timing, but it's really value timing is what it is. We look for values. If they're not there, we don't spend it. And right now we're defensive only because, we see the prices. I have to tell you, we're not that much cheaper than we were on February 28th. If you look at the multiples, the forward multiple is still over 21 times, okay, on February 28th. That's at the top end of the range, okay? And if you look, the last time we had a over 4% 10-year, which was '07, we were at a 15 multiple. Now, I know people don't think about that. Well, that spread is 40% to get back to that level. And then you could take it and measure it against anything on the 30-year average too, and it's all out of line. We're very high on current earnings, are like 28 times. So it's one of those things where you have to know where you are in the marketplace, and no matter what people try to say today, you're still expensive in this marketplace. Well, for us, that means that we have to have enough liquidity. Let's say this sell-off goes down another 2% or 20%. Any of those things could happen, and what you have to do is be sure that you're set up as such, so nothing can really hurt you. In other words, what hurts investors is to have the big hit that they weren't expecting, something that comes along or it keeps on going. Say you're in a 2-year bear market, but we just don't know that right now. I'm not saying we are, but if we were, and you just keep on chipping away, people are very highly exposed to stocks now. The most I've ever seen, really, I have to tell you. So anything that changes that, is going to affect that risk reward. Looking for us, the way we deal with it is we have enough liquidity so that if markets break, we're not going to get hurt that as much. I'm not saying we wouldn't come down at all, but we know how to manage the risk, I'll put it that way. The U.S. has gotten so far ahead of the rest of the world on a normal basis that everybody's buying the U.S. You see that GDP line down there, the black line, that just tells you that our market is so far ahead of what we're producing relative to the world on GDP that, it has to come back together. Those lines go together. The number one thing is that when the money came in to push the markets, every time these things happen, we're the first person to juice the markets, either the Federal Reserve or the fiscal policy. And so we led the way. And the U.S., when that money comes in, people buy things. And so it became the leading market, because all these other markets, they've been in recessions. They've been beat up. You look at Europe and China, and Russia, all these countries, they're not doing well. They're starting to come around a little bit. But what's happened is they said, well, we don't have anything else to buy. We'll buy the U.S. And now even in the MSCI or in those averages, worldwide averages, they're 2/3 U.S., 2/3 the big 10 stocks here. Well, I guess he's probably taking a page from Ronald Reagan, and I was in the markets then. When Reagan came in, the first 44 days of the market were up till he got inaugurated. And then we went into basically an 18-month bear market. They went down 30% or so, and it just ate away for the next 18 months. It was over in August of '82, but maybe he's taking a page out of that to think, well, we'll have the pain early. And I think that's what they're thinking, but maybe that's the outcome of what they think would work. But I think the difference is, I will tell you this, nobody owns stocks in 82, but a lot of people own stocks today, and that's the difference. If I went back and showed you ownership of stocks in 82, nobody wanted them and nobody owned them. If you look at it from 1966 or so all the way up to 82, they've just been beaten up. Market never went anywhere, never went over 1,000, and so they were wasted. And so all of a sudden, Henry Kaufman at Solomon came in and said, hey, we're going to lower the rates from 50, the treasuries, the rates are going to start coming down, and that kicked the market off, and that kicked off big bull market, obviously, over the next 40 years, but you didn't have anybody in it then. Now everybody's in it, the 401k, the personal, the pension plan, everything. So it's a different setup now, and we'll see if that pain goes over real well. Well, I don't have the graph, but I could show it to you, where really when in 18 and 19 both we had 10% drawdowns immediately on those tariffs that he was pushing at the time. It didn't last, no, but I think one of the reasons it didn't last is because the Fed was in there with zero interest rates. Well, it's 16 to 20. We were invested because we were more fully invested when the markets were lower, and we found more things we would own at the time. Income-wise, you had to be really careful then because rates were still down on that zero level, a quarter of a point on the Fed funds. They bumped up in 18, but that's what killed the market. And that was only for a quarter, actually. But you had to be really careful, and everybody stepped out to buy long bonds so they could get more yield, and it killed them, by the way. We wouldn't do that. We just said, hey, we're going to take the small interest rate for the time, and later on we know it would change, and eventually it did change. I pulled that from the Federal Reserve at the end of the third quarter, and we all knew, everybody knows that the top 10% of people with net worth own 87% of the stocks. And a lot of those are owned by this group over 55. But what you do with it is this, and that is, I think the allocations to people that are over 65, for example. I have people come through here at 75, 80 years old, and they'll have 85, 90% in stock market. And I'm like, well, we're not going to do business with you. And here's why. That's not good for you. I know that's what you want to do. We're a fiduciary, and I'm not going to take that responsibility, knowing full well you have too much in the market. And that's where we are today. They've not only got, and they're feeling good about it. That's why you're getting all the spending by the people that have the market, but that's the reason we look at things like that, because those people should not be fully invested in the marketplace. Their age doesn't allow that. If you go through a 20-year period, we've gone through 20-year periods where nothing happened, and they've got it all on the market. That's a problem for them. I think what's the problem is the last 14 or 15 years has gotten them in, lulled them to sleep, and they don't think there's really any risk anymore because it'll turn real quickly. Well, sometimes it doesn't. In a way, I hate to say this, but I'm going to say it because it's my experience. A lot of second and third generation people that get a lot of money don't have a clue, all right? I'm not saying all of them. That's not a blanket statement, but I will tell you this. A lot of that money will be spent. It'll be blown. It'll start out invested, but it won't end up that way. I've had too many people that have given a lot of money to the second generation, and I've looked up 15 years later and they barely had any of it left. The second thing is this group is going to live longer than people think, and they'll be spending a lot of it. They're going to spend a lot of money now. If you look at where you are today, if you're 65 years old, there's a good chance you're going to be 90. And so you look at that, and you're going to have to spend quite a bit more money than you probably think you would. Well, I think gold is signaling two things. Number one, I think the rest of the world does not want to own the dollar. I think they're saying, you know what, when we have extra reserves, we're going to use a lot of that money to buy gold. Now, we've owned gold for quite a number of years, and we've owned the miners the same way. And so obviously we have positions in those. But the thing about it is I think the rest of the world is saying that. And so they're saying, if you look at those central banks and people all over the world, they're buying gold because they feel better with that than they would the dollar. And in some respects, you can't blame them. If you look at everything that's been going on here is relative to our government, debt, et cetera, and what goes on. I think that's the number one reason. But gold is an interesting item. Over time, it does well. If you go back to the last 25 years, gold has beaten the S&P bonds. It's beaten everything out there. And everybody always says, well, it doesn't pay a dividend, and it doesn't pay a dividend. I always say this too, a lot of people own raw land out there, and it doesn't pay a dividend either, but they keep it. Well, I would have to say the Federal Reserve, to make the statement like they did last time that everything looks, all good, is like, well, what are you reading? Number one. But number two, if you look at the bonds themselves, themselves. I think what you're going to get is one more turn here when things go softer, either economically or the stock market, etc. I think you'll have one more turn in here where that 10-year will go below 4 or somewhere in there. We took 7 weeks ago, I think it was, right around there. We didn't have a position, but in their income accounts, we took a position in the 30-year Treasury with the idea, let me just say this to you, it's a trade for us, okay? We're not going to keep it long term, but I think if rates were to come down, that 10-year, down in that 3.5 or less range, I think it'll be one of your last times to get out of long-term bonds. I don't think people will, but I think they ought to look at it for sure. Because I think we'll reinflate again and we'll keep this inflation thing going. You look at it right now, we have stagflation. And so that probably would continue. And if it does, that's just a guess. We would trade it there and wait. Maybe they come back, or people think, hey, they're going to come back again to 1%. We don't really think that. We just don't think we're in position for the Treasury to be able to do that. And I don't think they want to do that. They want to push this paper out long term right now. If you get rates down, that's what I was saying, you get the 10-year down another 0.5 point or 3/4 point, we would be a seller. I think between now and mid-year, that's when you would get this breakdown in yield, probably because of the economy, the market, whatever, maybe all of it together. But later on, I'm talking about in the latter part of this year and then into next year, your inflation rate goes back up again. We felt all along it's going to average, for the next decade, it's probably going to average 3.5 or 4% on average. That means sometimes you'll have it at 5 or 6. But I think people have been lulled into thinking they'll buy a bond fund and they'll take care of it. Well, they buy long-term bonds. And so, if you look at the 3 years ended 24, they got wrecked in those long-term bond funds. I mean, the worst ever in the history of the bond market. Yeah. So this time you need to sell them if we get lower rates again. Yeah, well, in fact, short-term fixed income for us is less than 48 months. If you look at the bad bear market of the bond market during 22, 23, and 24, we did not suffer because we had short paper and we could adjust to, we had a lot of adjustable paper too. So as the rates were spiking up, it didn't affect us. Now, if you go into a longer period, say you go into a 10-year period where inflation's going to be higher, you have to keep your maturity short. Wall Street won't agree with that. They like to buy long paper, but the problem with that is you're making a 25 or 30-year bet that the rate you're buying today is what it should be. So we keep those, when I say short-term fixed income, we keep that at 2, 3, 4 years. We'll buy munis, for example, that have a short call and a short maturity both, and we'll get a better rate than most munis. But is this how you manage the portfolio? I think people will get back again. We've been seeing that this year, but I think over time they'll get back to where they looked at the true value of a company. What's it worth? What's that company's value? And not necessarily I'm going to buy momentum all the time. It's been nothing but a momentum market for 23 and 24. Just jump on and hope it goes up. But I think they'll get back to saying, okay, this company will produce enough cash, dividends, whatever, for me for the next 5 to 10 years that it really will make me a lot of money based on the fundamentals. That's what we call the value. And I don't really separate necessarily growth and value because a lot of good value growth stocks can become great values. And so that's what we look for. Real estate, particularly income producing real estate, and you look at all metals, commodities, you look at the Bloomberg Commodity Index, it really hasn't gone anywhere in 25 or 30 years, really, almost, relative to the stock market. So you're set up to where commodities could do fairly well, and people don't realize, but a lot of times commodities will do okay, even in a recession. But, I just think you need to own some real assets. And that can be a lot of things. For us, it's fertilizer and metals. We obviously own the miners, own gold. It's not the whole portfolio, but we put that into that sort of thing. I think one of the lost art today with people that manage money is that they don't understand how to take money off when things are expensive and put money on when things are really cheap. They just go out and buy 10 or 12 exchange rated funds or indexes, throw it in and say you'll be all right the next 20 years. Well, if you go through these periods that go long periods like 2000 to 2011, for example, you couldn't do that, all right? You had to take money out from time to time. And when companies get expensive, like they are now, you take money off. I think you could go through periods like that where it just goes up and down and up and down. I mean, when I first got in the business, the first 8 years I was in the business, the market never went over 1,000. And it traded back and forth 25 or 30%. You sat there with the same stocks, you never made any money.